All right, we are a little over a minute to go. We've got a Wi-Fi extender going today, so hopefully that's going to solve any of the technical issues that we had on the stream last time, and we'll be able to get through the next hour so nice and smooth. But I'm going to go grab me a nice glass of water, and we are a minute away from getting it started. All right, that is the timer, and we are going to get it started. Diamond Handsies is the first one to join us in the chat. How's it going? And slightly out of breath from running back up the stairs to make it here in time for the stream, but we are going to get it started. Thank you for joining us for another week of our weekly trade analysis and stock ideas and option selling strategies here. VS, more for, we got everyone in the Twitch chat. I'm loving it. All right. Hopefully you guys can hear me loud and clear this week. We got a Wi-Fi extender, so hopefully we don't have something like last week's disaster where it cut out on us twice. So we're going to start this off the way we always started off, where we recap the previous week we had. And it was an awesome week for us. It's always a lot more fun when we could recap a good week than like what we had last week when we lost a few $100. But these are definitely the weeks that are a little bit more fun to recap. So let me click in here really quickly. Having some hardware issues, so I don't have my external keyboard, so I'm using my laptop keyboard. So if I'm a little slow on the command and that, you're gonna have to bear with me. Cliffo, we've got Cliffo in the Twitch chat. How's it going? And I guess let's get into it. So right off the bat, I mean, last time we talked, we were kind of getting screwed over a little bit by our long positions. They kind of broke even. The weeks prior, they had been losing us money, right? We lost $750. And I guess the thing I kept trying to repeat, or at the very least keep telling myself, was that, it's a lot easier when the long plays go our way that we have up here at the top of the tracker. And that's exactly what happened for us last week, right? UWMC didn't necessarily go up. I'm not even sure it went up at all. We could fact check myself right here. UWMC, if we go to the 5-day chart. I mean, it went up 15-ish cents, but that's nothing too significant. But the good part about that is as the IV on these options drop, the time to expiry decreases, and they lose their value. So we were still able to make, despite only a 15-cent increase in the stock, we were able to make a decent $1,000 on UWMC last week. So that one was really nice. We also additionally were able to close out our September 17th 7-strike puts. We sold those at the back end of last week for 33 cents a piece. And it's one of those things where September 17th is still a decent ways away. So if we were in a situation where in the first few days or first week of the trade, in a trade that lasts 3 or 4 weeks, we're always going to be happy to get out of there with 50% profit. That's exactly what we saw. And we got to the point where, honestly, if we didn't take that, it might have been a little bit greedy. But we did that. We took $360 off the table. So all in on UWMC, we were able to get $1,300. SoFi was also a really nice one. We've only really held this one for a couple of weeks, I think. When did SoFi come out of the tracker? Yeah, SoFi came out of the tracker not last week, but the week before that. So we'd really only held it for 2 weeks. And you can see right here, we got $250 of profit from it on the first week. And we got $800 of profit on the second week, giving us just over $1,000 of profit on that position. So that worked out really nicely for us. And we were able to sell those, I don't want to scroll back up, but we sold them for 84 cents a piece. And, we picked the January 2022 10 strike puts. Why did we do that? We talked a little bit about this the past few weeks on our streams, but it was a relatively safer play, and with the margin buying power requirements that TD Ameritrade allowed us, we didn't have to tie up a ton of cash to do it. So what we had was a decent amount of, a decent return on capital and a relatively low stress trade because, SoFi really wasn't ever close to being at a 10 strike at any point, right? So if we type in SoFi's chart, it wasn't ever terribly close to getting down to 10 a share, right? There was this nasty drop from 17 down to around 13 or 14. But beyond that, it leveled out decently. And if we take a look at the options, those January options that we sold, let me open those up really quickly. You'll see that those are down even further. Actually, what did we sell those for again? We dumped them for 63 cents. So they pop back up a little bit. I mean, maybe not the worst idea in the world to get back in since it's pulled back since we exited. But if we pull up the chart on these options, you'll kind of see what we're talking about here. If we go to more info, TOS charts, and then pull it up here, we could plot the actual price of this option to kind of demonstrate what we were banking on, right? So if we look at this from a 180-day perspective, this thing's been all over the place. It's traded around 75 cents. Where my mouse is right now is about mid-July. It got down to a base of 54 cents around August 11th, which is right here. And that's right when it was up to around, $17 a share. And then after this big drop off down to the $13 or $14 price level, these puts, even though they were at a 10 strike and their break-even price was represented by this red line down here, they spiked back up to about $1 in premium. And while we didn't exactly time the top, it's one of those things where you're never going to time the top in the market. So we got into 84 cents. We knew where the price of this had been historically in relation to SoFi's price. We were confident this was going to be at least a short-term level of support. We got that short-term bounce. We sold them for 84. We got out for 64. And while we say we'll never time the top or the bottom, we had a pretty good exit, admittedly, on these. But, that's why it's always so important to take profit, because the only thing that you could really see when you're trading in a week-to-week basis on the market is what is there in front of you. We saw that profit in front of us. We took it. And now we have the opportunity, if SoFi, comes back down again, to maybe get back in at the 80-cent level and still keep all the profit that we had from before. So that's something we'll keep an eye on. But this is an example. We typically trade weekly expiry options. This was a good example of one where there was a decent bit of value in going further out of the money, picking a lower stress trade and taking advantage of the price action on those as IV kind of levels off and as prices rebound. So that was one that I thought we executed really well. I was happy with that. ICLN, we don't really talk about that one because it's super, super boring. But we potentially are finally at the point where it's almost back to our break-even price. And we started playing this back in February for when it was above 27 a share. This is a super boring clean energy ETF. But the point is, if you could see in our formula bar up here, we've basically infinitely lowered the break-even price bit by bit by bit by bit, and eventually we're going to break even. We're at a negative $3 return so far on this trade, but if it goes up a few cents from where it is currently, we'll break even, and that's further emphasizing the point here where a lot of our losses with this strategy are really only temporary, and we'll be able to get back in the game at some point. Corsair, this is one I might regret a little bit because it finished at like 27.50 or something like that. We could take a look really quickly. Yeah, 27.54 is what Corsair finished at on Friday, and that would have been a decent gain for us, right? If we threw a 27.4 stock price in there, that would have been another $2,000 for us. But it's never fun to play the what if game. We could only trade with what's in front of us. We didn't love the fact that there were only 64 cents of premium left on these 27.5 strike calls. And that really, for as big of a downtrend as Corsair was in, wasn't enough of a cushion for myself personally to want to continue in that trade. So we got out of it. And I mean, whatever, I'll take $120, but we took a lot of buying power off the table. We freed up some cash, and we were able to put that cash into other trades. So while it was one of those in hindsight where we can look back and say if we had held on to this, we would have made a lot more money, what we did, I think, objectively was smart because we didn't like the amount of premium that were being offered by the option selling portion of this trade. And I say so often, if you're not 100% in love with the trade, there's no need to stick in it. There's so many different tickers out there, so many different option selling opportunities that you don't need to be halfway in on a trade. So we moved on from that one, somewhat regretfully, but I think intelligently. And making decisions like that, even though they're tough to look at in hindsight, are what is going to propel us to long-term success with this strategy. PSTH is one that's hanging out in the 1970, 1980 area. I think our break-even price after I plotted out all of these that we sold, or I guess we could say, where is it? All of these that we bought, our break-even price is about 1985, because that is the point where the long calls that we purchased and then our debit spreads are going to break even. If we put 1985, there we go. That's our break-even price. So we'll back that out, and I should probably go ahead and put the actual formula in here so it updates itself automatically. But this is where we stand. It's a longer term play waiting till October. I mean, this is one where legally the idea is that the SPAC is going to pay out $20 a share. So this will be worth at least 20 come October 15th. But, you know, no guarantee that that is done by October 15th and no guarantee that it makes it back to 20 by October 15th. But that October 15th, I sit back and wait and we'll just see what happens. So there's nothing wrong with taking that up list if I could actually get out to the list. Clover, CLOV is it again. We've played it the week before. We played it the week before that as well. And it's really been a nice moneymaker for us at the current price level around $8 a share. We made about, let's see, $760 from that one. And that included some puts that we rolled over from last week. These 8-strike puts, we rolled them down and out. We rolled them down to 7.5 and we rolled them out a week. And we were able to make $540 off those individually. Clover Health shot up, and we could go back to the one chart view here really quickly and put in Clover's chart to talk about what happened over the past week. But it shot back up above this $8 level, and the $8 level is really where we love to play this stock. So it shot back up. Looks like the Wi-Fi has cut out again on us. I think we're back on. I'm hoping we're back on. Let me know if you guys can hear me. Looks like it's kind of coming in and out a bit from my end. And I think we should be back up and running right now. So let me know if you could hear me in the chat, and I'll keep it rolling as if none of that ever happened. Hopefully that was an isolated event as opposed to the whole stream going down like we had to have happen last week. I think plan C for me might just be the longest Ethernet cord I can find to run it straight up to my laptop. But we will cross that bridge when we get to it. We're going to keep it rolling. So Clover Health is one we love to play around the $8 strike. We had the opportunity to continue to enter into more of those $8 strike puts. When it did run it back above 8, we sold those for 15 and 17 cents respectively, which put our break even around 7.85, just below this red line that we drew right here. So we were perfectly happy to do that. Looking forward to next week, this is going to be another one that we actually might think about getting back in on, just because we love it around this $8 price level. If we take a quick zoom out on the chart, we see that this red line that we drew just below $8 a share, offers some decent support. Does it break through here at some points? Yes, it happened back in March, happened for a little bit in April, happened a little bit in May, but in general, it is come back above that. And this area that we see right here from about July 13th to August the 18th, there was some really decent support off the 8 level. And then the one time that it did break it, less than 2 days later, it shot right back up through that $8 level. So we're perfectly happy to continue playing the $8 level on this stock until it either runs away from us or drops further and we have to start rolling our puts down and out. But, we can still, at that $8 price level, get a 1.39% weekly return, which is a really nice return on a weekly basis objectively. So that's something we're perfectly happy to keep going back to. We might sell 10 or 15 more of these come Monday morning. But that is something we will keep in mind, and we will keep moving forward as we look at some of the other trades that we have from the past week. Blackberry was another one where it shot up. There was a lot of implied volatility on that one. That quickly cut out, and we could take a look at the chart here really quickly. If we pop over to BB, there you have it. We saw this big green candle back on August 23rd and 24th. There was a big move up to about 1014, but it wasn't until this larger candle up past 11 when we decided to get in on the trade. And if we plot the implied volatility study on here, implied volatility, you'll see there's this big spike in implied volatility, and it eventually fell back downwards. And that's the kind of action in implied volatility that we like to see all the time. And that is the implied volatility action that we like to play in the context of our strategy. So when that happens, right, it jumped up to $11 a share, and we were able to get back, we were able to sell a 10 strike put for 16 cents of premium, meaning as long as it stayed above 10, we were going to make $16 per contract that we sold. And that's a really nice value proposition when you have something trading at 11 with 3 days until expiry, basically meaning that as long as it doesn't drop over 10% in the last 3 days of trading of the week, we were going to hit that max profit, and it turned into some decently nice profit for us. We pulled a safe $210 off that. CRSP is one we call a safer play because this is a stock that we're a pretty big fan of for the long term, and we've rolled it forward to next week as well. So let's discuss this one a little bit, since this covers a little bit of what we were doing last week and what we have as we move forward into the upcoming week in the market. So if we take a look, as we typically do when we start analyzing these trades, CRSP, here we go. There you have it. We'll go to the 180-day chart so you can see a little bit more of the price action. And the premium on this one exists, yes, because there's some seriously volatile action on a day-to-day basis. But even in the last 180 days, this thing has peaked at 222. Decent support in this 110-ish level. This line right here is at 107.50 that we have drawn. So we're pretty comfortable taking assignment anywhere around that 110 basis. And that's exactly what was happening with the 111 put that we sold, right? So we sold a 111 put. We got 95 cents of premium. That would put our initial basis, our break-even price, at $110.05, right almost exactly on that 110 line that we were happy to enter into the play with. And the great part about that premium is that we were able to sell 4 of these and make $380 on a trade where, as long as it stayed above 111, we were going to hit max profit. And if we take a look at the past month, so we could take a closer look at the past week, that 111 max profit point, we have to zoom out on the y-axis just to get there. It really never even got remotely threatened. So we're really happy with the way this has turned out. Again, number one rule when we're selling puts is you got to be certain that you're selling puts on a stock you're comfortable owning in the long term. This is one that I'm comfortable owning at around 110 for a long term because it's an interesting company. It's gene therapy, which is something that I think is going to be a really huge area in the future. So a decent stock to be invested in. We could back it up a little bit further to a year, and you'll see there was a pretty big run up in the past year, but it's since settled back down. And we could even take, let's pull up RSI for good measure here to kind of round out the analysis. Trading at a place at 47, 50 is the midpoint of the RSI reading, so really neither overbought nor oversold. So again, just a decent entry into a decent stock that offers decent premium, so it's something we're happy to keep going to the well time and time again. And if you saw when I scrolled back down here on that profit chart, you'll see that we got into 113 strike puts for next Friday, which are offering 160. So at max profit on those, we are going to get 480 if it finishes above 113. A little bit higher than what we had last week, despite selling fewer contracts. So that's the reason I'm selling 3 instead of 4 of them, because last week we sold 4 to make 380. This week we had the opportunity to sell 3 to make even more than that. So in the spirit of being conservative when we enter into these trades, that is what we're going for. That is what we're going to do. We start small, and if CRSP tanks and heads down to 100, we'll have more capital that we're free to allocate, right? We're only currently using 24.53% of our available buying power heading into this upcoming week. This is the most buying power we've had available headed into a week. So, we're trading cautiously, one, because the S&P 500 is a little bit scary right now after how much it's ran up lately, and I feel like I say that every week in the face of it just continuing to rip upwards. But eventually we hope, maybe not hope, but expect to see some sort of pullback, and that's when we'll start deploying more of this buying power. Timing on your entries is very important. I mean, it is and it isn't important, but being diligent and being disciplined in that entry is what's important, maybe. So CRSP one, we're certain 13s for next week, which offer a 0.89% ROR overall, which not huge on a 1 week basis, but we'll remember that even just a 1% return weekly returns a really nice amount when annualized. And the fact that this has some really nice margin requirements, right? Fully cash secured, if we sold 10 of these, it'd be $112,000. But, it only requires 40. So for the example that we have set up where we only sold 3 of these, fully cash secured to take 33 grand, but with our margin buying privileges, it's only going to take $11,000 of buying power. So perfectly happy to jump into that trade the way that we have it set up. Back to round out that previous, the recap we had for last week. Alibaba, we got in and out of this one because there was a ton of premium on deep out of the money options because of the huge drop they had with Chinese regulation fears. And because of those fears, we took our profit when we saw it. SKLZ, FFIE, PLTR, these were all, relatively low stress options we sold that were slightly out of the money and ended up expiring for max profit. And as far as what we're going for next week, SKLZ is one that we rolled into next week, and we could talk about that one really quickly as well. SKLZ, believe this one was a former SPAC, a huge run up to 46, but has since come back down to this $10 level. And what we know about this $10 level for SPACs, the reason it's so important is what it's formerly what was the net asset value of the SPAC, which pre-merger was the amount of cash that they had in the company, and would act as a price floor. Post-merger, that idea is out the window, so it definitely could go below 10, but I would expect to at least see a little resistance at that $10 level before it does continue to go below it. So that's what we're playing, right? We're going to sell 10 strike puts week after week. These they offered more when we entered into them, right? Because we sold them for 21 cents, and it's since bounced back up and is looking really nice for us. But when we entered, they offered about 2.5% return on risk and an even higher percent return on capital because they have some decent margin buying power requirements. But taking a look at that chart over the past month, decent bounce off 10. I'll continue to play it at 10 so long as there is decent premium there. So that's why we rolled that one into the following week. SPRT, this was kind of a fun one that we could talk about really quickly as we round out our discussion for last week. So one of the strategies that we like to talk about so much on this channel is the IV reversion strategy. And that is something we play when there's a huge spike in a stock that typically also results in a huge spike in corresponding option premiums. So if we pull up SPRT, there you have it. You'll see that there was a huge spike in the stock. And if we go to the implied volatility study back on the bottom here, all studies I through L. Oops, I'm going rogue with the mouse here. Implied volatility. There you have it. We'll see that there was also a huge spike in implied volatility up past 4 here. So when we see big spikes in implied volatility like that, inevitably they all come falling back to earth. But what does a spike in implied volatility mean for us as option sellers? It means that the options are going to have more premium, and that's great for us because when we sell options, we want them to have a lot of premium. So what we were able to do was, despite the fact that SPRT on Friday spiked up to $30, $40, $50, $60 at the peak midday, we were actually able to sell these 7.5 strike puts for 45 cents of premium, which is kind of crazy to think about because the premium on those increased despite the fact that the stock shot up a bunch, right? It's counterintuitive to how you would think about a put option. With put options, when the stock goes up, usually the value goes down. But the great part about this implied volatility reversion strategy that we're using is that when the price goes up rapidly, not only one, does it make it less likely that it's going to go back down and make that put worth anything, but 2, the implied volatility from that spike actually increases the premium of those puts, counterintuitive to what you would think based off that price action. So we're able to sell those for 45 cents. Before the end of the day, we closed them out for 35 cents a piece. So it was a $10 profit per contract that we sold. We sold 20 of them. So it was a $200 profit from that on Friday. Now the question is, you sold a 7-strike put. You sold it for 45 cents. The break even on that's going to be 705, which is this red line that we had plotted here. Why did you close the position? And the answer lies in buying power, because with this big spike, sometimes we talk so often on this channel and on these streams about how brokers can give you preferential buying power privileges. So if you wanted to open a position worth 20,000, it may only require 10,000 or 5,000. And that was the case on Friday, right? When we opened all of these, it required a much lower amount than it ultimately did once TD Ameritrade decided to deem this a high-risk stock and require it to be fully cash secured. So our buying power kind of got evaporated a little bit at one point there Friday. So we said, hey, let's take profit if we can get it, get out, and most importantly, let's get that buying power back. So we put in a limit order to close these out for 35 cents a piece. That thing hit. We made 10 a contract. We sold 20 contracts. That's $200 of profit. And we did something super similar with the March 2022 2.5 strike puts, which is, almost an even crazier concept, right? Because while for the September 17th 7.5 strike put, our max profit point was going to be that 7.5. For the March 2022 2.5 strike put, our break even was going to be $2.10 a piece, which, looking at this chart is almost seemingly impossible for this thing to get to down here at 210, right? So the reason why there was that much premium is because of this implied volatility, not necessarily because it's going to come crashing back down to earth below 210, but because of the way the options are priced, that huge surge in implied volatility also resulted in a big surge in the price of these, and we were able to get out pretty quickly. $5 contract per share that we sold, 100 of them sold, $500 of profit. And that, in what I will hope to at some point in future streams be a quicker wrap up, is how we arrived at an awesome week where we pulled a 3.84% return and pulled almost $6,000 of profit. So we were super happy to have that. Again, that was a it was our 7th best week so far on the year. So we were super happy with that. And we're going to roll it into next week, as we mentioned, with the most buying power that we have had for a single week yet. So as we go through this, we're going to try to look for some trade options, trade opportunities, trade ideas for the upcoming week. If there are any stocks that you guys want us to take a look at, let's start with our option scanner and see what we can see for the upcoming week. The only trades really that we rolled into the following week were CRSP and SKLZ, which we talked about during our weekly recap. So let's finally try to develop some new trade ideas here on the stream so we can have at least a little bit of a list or an idea of what we're going to be looking at when the market opens on tomorrow morning. But I think the best thing to do first is take a little more of a macro look at what's going on in the market, right? We have all these individual stocks. We have this watch list. We have individual price action on the stocks. But again, what drives the market, right? The market typically moves together. A lot of stocks in general are correlated to how the overall market is moving. So to begin that discussion, let's take a look at the S&P 500 index. We'll use the ETF SPY. That's what we benchmark our performance against. Let's go back to the 180-day chart. So I think the best thing to do here is also pull up that RSI study, and then I'm going to take a quick sip of my water. All right. So we could see basically over the last 180 days, and even if we extend it out to the past year, I mean, the S&P 500 has almost taken a straight line up since the COVID crash back in March of 2020. So I mean, I've been saying this the whole way up, and don't get me wrong, we run a bullish strategy, so we're benefiting from the market going up. But, there has to be some sort of a level of skepticism, since if you take a look at RSI over the last 3 years, or even, before we get into that RSI discussion, if you take a look just at the stock market chart for the S&P 500 over the last 3 years, ignore the COVID crash, you have decent pullbacks at different points throughout the progression over the last 3 years. But if we look at what's been going on since about March this year, I mean, there was a little bit of a pullback there, but even since November of last year, we really haven't had any meaningful pullback or decent red candle in the market. So this is kind of crazy right now, and I'm a little bit hesitant. Oh, we've got someone on YouTube saying they normally do calls and puts, but our strategy is a monster. Appreciate that. I think everyone, have I tweeted my scanner at all, or is it the same? We posted our scanner results on our website, but we've got the scanner here. We're going to run this one back a little bit after this quick discussion, so we've got all the results right here. But this has been downloaded and uploaded to our website, so you can view the results for it before the upcoming week. But with that in mind, before we get into that again, to close the loop on this little discussion that we've had about the performance of the market so far in the S&P 500, we really haven't had a decent pullback. And what is the best metric to assess a pullback? And I always say it's RSI, and RSI, when it gets above 70, is considered overbought. So you could at least somewhat bank on a little bit of a pullback. Now, before the COVID crash, it started getting up to about 78 or the 80 level before pulling back. And, that pullback was independent of price action, right? It was more news driven from, the emergence of COVID. But, when we get back up here and start trading a little bit more off price action and fundamentals in theory, seeing this elevated RSI, we would expect to see the market give back at least a little bit. Because I don't know, we can go back to the 5-year maybe. And while it's not necessarily overbought on the 5-year, looking at the 5-year chart almost makes the context of this upwards move even more insane because we really haven't had any decent drop. We had a decent drop in 2018 at the beginning, decent drop at the end of 2018. And one little random fact that I love sharing and is very relevant for what we're coming up to is September is typically the worst returning month of the year for the S&P 500. That's not a secret. Other people know that, and I think other people trade based off of that. So that's something you're going to want to be cautious of. And to answer that question in the chat, is our strategy better with a bullish market or a bearish market? It's always good when stocks go up because our strategies are bullish to neutral. However, when the market goes down, our strategy is actually built to outperform the market because every single trade that we enter has a built-in cushion to the price. So it could drop X amount of percent, but we'll still make money. So the market could be pulling back, but as long as it's not pulling back too sharply, we could still make money while the overall market is losing money. So that's the big advantage of our strategy is it's built to outperform when the market pulls back. But even when the market does go up like this, as you can see from our performance so far in the year, we're still able to make money because these are all bullish positions that we have been opening. So hopping back to this, and I guess the one theme that I want to take away from this as I jump into the discussion of individual stocks is I think we need to be very cautious moving forward. That's why when you take a look at our profit tracker, we're only using 25%, less than 25% of our buying power, and we're being very, very cautious with our entries into these stocks. Things look very overextended in my opinion, and I think we're bound to come crashing down at some point. I just don't want to be the one, and I don't want you guys to be the ones holding the bag when that does happen. So being very, very cautious is the name of the game this week as we evaluate these potential trades. So going straight into our scanner, we're actually going to release a video that I just created. I'm rendering right now that I'll upload tomorrow. Rule number 1, this is also something we're going to be talking about in the video, is that we want to avoid biotech stocks because, they have the tendency to shoot upwards or downwards at rates that we really can't use our strategies to recover from. So if you'll take a look at something like SAVA, which was at the top of our scan, you'll see these insane moves up and down, and insane moves up and down create option premium. So as a result of that, there will be some opportunity as far as option premium is concerned. But I would encourage you, these are huge numbers from an ROR perspective and literally the highest in the market this week. But I would encourage you to stay away from these because while it can be tempting to chase this kind of return, there could very easily be another huge candle down with a position that you don't want to hold and a loss that is going to be very difficult to recover from. So we're going to ignore that. Next one is Newegg, NEGG on the scan, and we could throw that in there. This is another one I talk about specifically in that video. Whoops, that didn't type for me. There we go. NEGG. And we can see this one, a lot of premium because there was this huge spike up to almost $80 a share and then back down. And it's currently trading at about 1905. But again, in the, with the idea of being cautious as we enter into these trades, where is the support here that we see on the 180-day chart that we're looking at? It's really not until you get down to the $10 level and maybe the $9 level. And below that, there's another leg down to the $4 or $5 level over here. So this is not a stock I would want to own at 19 bucks a share. And while the premium around that might look decent, it's really not worth it to me. I would not want to be assigned this stock at 16 bucks a share, even though that would give me 2.6% returns, because I think it has the potential to go down to 10, and that could make me a big loser in a given week. So we're going to ignore that one. RIDE is Lordstown Motors. They have a lot of premium because they just announced a new CEO. But at the same time, they're the same company who I think a month or two ago announced that they might not even have enough cash to be able to begin operations. So again, not exactly a company that I would want to own. Moving a little bit further down, FFIE is one that pops up here and one that we had last week in our portfolio, and I think one that wouldn't be the worst idea to jump back into again. We could pull up the chart here. Former SPAC, we saw that the former $10 price floor resistance-ish, I guess ish is probably the best term to use because it broke through that a bit and bounced off the $9 level. But I think anywhere around this level is a decent entry for FFIE, especially because on a week-to-week basis, these puts are offering some really impressive premiums. Even just the 8.5s are offering 2.10% a week, which we know a 2.10%, if you get that every single week, you are going to be very, very rich eventually. So, and again, that 2.5% return is at the 8.5 strike put, meaning as long as FFIE finishes above 8.5, 5 days from now, right? We're still looking at the 180-day chart. We could zoom into the 5-day chart, and we have to zoom out again. So as long as it stays above that red line for the next 5 days, selling those 8.5 strike puts is a trade that is going to hit max profit and give you a 2.1% return on your capital at risk. And I think this one has a 50% margin buying requirement, so you actually get a 5% return on capital if you choose to use that to your advantage. So that's one I like that popped up on the scan. Another one, if we sort it alphabetically here, is, as we talked about a little bit at the top, Clover Health. You know, those 8.5 strike puts are offering 3.6 cents a premium. We like playing the stock anytime it comes back around the $8 price level. However, you know, the 8.5 strike put might be pushing it a bit, right? Because the 8.5 price level is right here. And as we saw with FFIE, you know, there are stocks out there that give us the opportunity to have cushions that are down here. So with CLOV, I mean, maybe that 8.5 strike put at first glance is probably not the best way to do it because you're up against the price. That's a little bit risky. But, you know, just because the 8.5 strike put is what showed up in our scan doesn't mean that that's the option that we have to sell. So if we take a look at the option chain, we could just go down to the next strike that's offered, the 8 strike, where you could get a 1.39% return in a week, which is still decent. You're going to get about $10, $11, or $12 of max profit per contract that you sell here, and then you'll have your break-even price right around $7.90 a share. So again, another opportunity where over the next 5 days, you have a break-even price that gives you a decent cushion from the price that the stock closed at on Friday afternoon. Back to the scan, and you know, full disclosure, those are the two I point out because those are the two I use as an example in the video that I filmed or recorded this weekend. So I knew those were going to be decent opportunities. But let's keep going down the list here, right? Let's take a look at SIG, an 80 strike put. SIG, Signet Jewelers, and you know, let's do the process that we like to do where we back up. We've got a request for CLVS. I'm going to put that on the list really quickly, and we'll take a look at that after this. Signet, let's zoom in here a little bit, and it looks like, you know, these are offering some serious premiums, right? Let's look back at the whole list again, because even down at something like 70, you could still get a 1.89% return. I mean, the volume isn't huge, but, you know, there's enough volume there to at least fire off a few of these and get some fills. If we take, what scares me about the last 180 days, which is something that, you know, kind of the big reason I look at these 180-day charts first, is that this thing was trading at 24.9 180 days ago, and it is basically over 3x'd in value since then. Let's go a little further back. Let's see if there's any precedent for this. No, it's up even higher beyond that. The 3-year chart, maybe? Yeah-ish. I mean, it used to trade back in 2018 at 66 a piece, but, you know, at the base, at the trough of that pandemic plunge, it was trading about 560 a pop. So this is a huge run-up. If we go back to that 180-day chart that we love to use, you'll see that the RSI is at 80, which is super overbought. Why do we like to look at RSI? Because the last time RSI was this high, if we look vertically up here on the chart, it pulled back from 42 to about 34. So anytime RSI gets this high, we could, you know, start to expect a pullback, meaning this is probably not a great entry into the stock. On top of the fact that it's, you know, it's 3x'd in value over the past 180 days, the past 6-ish months. Yeah, that sounds about right. So, you know, not really a great value where we like to kind of I mean, compare this to the chart of like an FFIE where we jump in because it's bottoming out and we think it's going to rebound. SIG is really more so a setup where you're chasing at the top, and that never turns out very well. To completely beat a dead horse, since we talk about this a lot, Hyliion is an example of where we did exactly this, right? If we take a look at the 3-year chart, we jumped in on this stock right around here, and this setup looks very similar to what we see with SIG. And as you saw probably before I zoomed in, the result of that getting up here was that we maintained our position and had to endure a pretty big loss as this thing dropped back down. So we don't like to chase those setups that we see with SIG right here, because RSI is elevated. This thing is begging to come crashing back down at some point, and we are not going to be the ones who take the loss when that happens. So we're going to stay away from that one. Moving further down the list, AMC, we know the deal with AMC. I personally think it's super, super overvalued, so not one that I personally would like to trade. I'm going to skip that. Futu, F-U-T-U, Chinese company, that's another one where there's a lot of regulatory risk currently in the market with those Chinese companies. So that's something that I've been looking to stay away from as of recent. If we scroll down a little bit further here, we've got Mara, crypto stock. I mean, I'm not a... the issue I have, and I talk about this a lot in the Discord with the crypto stocks, is that, you know, I worry about how correlated these stocks are to the actual performance of Bitcoin. So if we take a look at Marathon, right? I mean, this thing has gone from $4, it went up to 60 at the peak, right? Which is over a 10x increase in value, which is something I don't think Bitcoin did in that time frame. It was, you know, a much more exaggerated increase on a percentage basis as opposed to the increase in Bitcoin. So anytime Bitcoin has a small pullback, you know, there's a bigger pullback on a percentage basis on Marathon. So that's one I try to stay away from as well. Let's go back to the chat really quickly. We had a request to take a look at CLVS, and I think this might be a biotech one if I remember correctly. There we go, Clovis Oncology, and one weekly options, not enormous premiums on these. Look right here. If we go to the fundamentals tab, we can type in CLVS so I can get acquainted with exactly what they do. And there you have it, right? Biopharm company focused on acquiring, developing, commercializing anti-cancer agents. And what we see over here is kind of wild, right? It used to be trading almost at $100 a share and has since leveled out. But in the scheme of things, for being a biotech stock, well, I was about to say it didn't look too volatile, but I think if we take a look at the 180-day chart, there definitely is some volatility. But, you know, what I'll give you is that it's on the bottom end of this. We hated the setup that we saw a minute ago with SIG, where the stock had been running up over the past 180 days. What we like about this one is that it has the potential to run up. It's fallen back down, but it's definitely on the low end of that range. Let's back it up to a year, see what we can see. Looks like there's decent support around this 4 level from back November-ish in 2020. And that's exactly what we saw back here last week, or 2 weeks ago rather, when it bounced off that 4 level again. So the 4 level doesn't look to be too bad of an area to get in at. However, when you look at the premium around that 4 strike, there isn't a ton there, to be completely honest with you. So, I mean, unless you're absolutely in love with this, quarterly spikes is what we're saying. Yeah, I mean, potentially quarterly spikes. As far as the strategy that we're working with, options selling, I don't think there's enough premium there to justify selling options on something like this. And while I never recommend buying options, sometimes if the premium is so small that we don't think it's a great idea to invest in, you know, maybe not the worst idea in the world to purchase an option on, as much as I typically discourage that. Because if you're able to catch a spike from 5 up to 8, or something like I don't know, 4 up to 11, and what's the time frame on this? This is from December to February, so I guess these aren't huge spikes or anything like that, or I guess rapid spikes. We have one spike back in March that was pretty rapid from 5 to 8. That's what we're looking at. Looks like there was another one back in June. And I mean, while it is somewhat coincidental that these are quarterly, it's not really something I would tend to try to bank on happening. I think that's like you banking on the fact that, hey, I've won the lottery 1 out of every 10 tickets I've bought. Let me wait until the time frame when I would normally buy my 10th ticket and get in on this trade. So I think taking an option buying approach to this is something that's just going to result in you kind of pissing away money. I don't think there's enough premium there for an option selling approach that we like to outline. So as far as the context of our strategy, I think I'd want to leave this one alone. Unless you really are happy with getting it at that 4.5 level, because again, we think a 2.04% return on risk is really nice, but you're only getting about $8 a contract for this, and only 4 of these were sold, so the volume really isn't there either. To really do some damage with that, you need to sell a decent amount of them, and only literally 4 of these sold on. I'll pull it up on here. We've got Warriormen throwing some serious graphics in there. I can't really tell what they look like on my side, so I hope they look prettier in the Twitch chat. Excuse me, MCRB, more for. Did we ignore you, or was that just some more comments on the biotech comments that we made? Scrolling down, MSTR. We can take a look at both coin and MSTR. Special request from Morpfor, but those are both crypto names, and I think both are probably very relevant to talk to back to back. So let's look at Coinbase first. And Coinbase is good because it's the single largest cryptocurrency broker in the United States. I think we had a stat come through in our Discord server saying that they have more customers or users on Coinbase than Fidelity has for stock trading in the United States. So that really kind of speaks to the size of Coinbase. Now, what's interesting here is something that I do want to take a look at, and something we could take a look at live on the stream here, is what is their correlation? Where do they derive their profit from as far as crypto is concerned? Is it because they hold a bunch of it, or is it more of a they benefit off transaction fees? So the more activity that there is in the crypto market, the more revenue that they're going to generate. And to be honest, that is not something I know the answer to off the top of my head. So we could take a dive into the handy dandy SEC filing database, SEC Edgar. If my computer will hurry up and do this. There we go. I spelled it wrong, but Google's got my back. So, brief overview of what we're about to do. This is where when a company reports earnings, or a company files anything, or there's any company news like that, this is where you're going to find it. And I think it's funny sometimes because after earnings, people say, oh, I don't know what their EPS was. This website says this. This website says this. My broker says it was this. What were their actual earnings numbers? In a literal sense, you could come here and find the actual hard earnings numbers from their 10K or 10Q for quarterly reports. But the one that we are going to look at right here is Coinbase, because we're trying to get a little bit more information about where they derive their profit from. And we're going to take a peek at the annual report because I think that might have some info like that in there. I think balance sheet's going to be a good place to start because that'll let us know if they're holding a ton of crypto. And there we have it, cash and cash equivalents. So the question here, they're holding 4.3, are these in thousands? They are in thousands. So they're holding 4.3 billion in cash and cash equivalents. Now the question here is if we control F for cash equivalents. Sorry for this slow typing because I'm typing with one hand on my laptop out to the right. Cash equivalents, cash equivalents. Let's see what we can find here. Doesn't look like there's here we go. Crypto assets held. And this is the answer that we were looking for. So of, these assets that they're holding, they have $5.6 million in crypto, it looks like, which, excuse me, hold on. The following table summarizes the preliminary fair value, blah, 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 as of the date of acquisition. So this is net assets acquired, which makes me wonder if they were already holding. Let's just look for crypto assets held. I look for crypto assets. Now this is interesting. They've got some revenue that they're deriving from these. Bear with me on my Control F journey through these financial statements. All right, where else are we going to see it? Purchase of crypto assets held. So it looks like on their cash flows, at least, they purchased at least $1 billion of crypto. We could see right there. So the number is going to be pretty big. So I think at this point, the fact that the last, what's this cash flow presented in? The 6-month cash flow says that they purchased $1 billion of crypto. I think to answer my own question that I posed without, boring you guys to death, looking here. Here we go. Crypto assets held. 585 million in crypto assets as of June 30th, 2021. And this is exactly where we're starting. So if you were just screaming at me to read a few lines further down when I first opened this up, I apologize. But there it is right there. They have 585 million in crypto assets on the balance sheet. So they are decently correlated, somewhat to crypto, right? And this isn't just money in crypto that they're holding for other people, because that's represented by this line, customer custodial funds. I imagine their customers have roughly 9 billion of crypto sitting in their accounts. So, yes, they have some exposure to crypto, but if you take a look at it, right, they have 585 million in the context of 15.7 billion in assets. So if we hold out we pull up our old PC system calculator here, that 585 million, 585,846 divided by 15,790, this number right here, 15,790, 208, means that the actual crypto assets they hold are really only 3.7% of their total asset exposure. So really not a huge amount. And I think the answer to that question is there isn't a ton of crypto exposure from Coinbase. So this isn't a pure crypto value play. However, if we look down to the income statement, it looks like a lot of their revenue, they have net revenues, other revenues, transaction expenses. I would like to know a little bit more about this number, the net revenues, and where they derive that from. Just to sleep with this, but I think answering the question here is, or the initial question we came into here to answer was, is this going to be more of a play based off crypto value or crypto activity? And the fact that crypto value really only drives about 3.7% of their assets lets us know that this is more of a crypto activity and interest trade. However, I would tend to believe that crypto activity is pretty highly correlated to crypto value, but not entirely directly. So with Coinbase, I think crypto is only going to get more and more active. I don't think it's a bad investment per se. However, it's a little bit scary. It peaked at 429 on the IPO that we see right there, leveled out at about 220. But where could we try to get back in? RSI looks neither overbought nor oversold, sitting at 57, which is a relatively neutral reading on the 180-day RSI. So that's not something that we're terribly worried about as a factor for entry into this trade. But what's great about this, with how volatile it is, there's decent premiums on a day-to-day basis. I would agree with you, Prinsmeister, there. I think 220 is a good entry, but not a ton of premium down at that 220 level. And as far as timing your entry, it's not really the greatest either, because on Friday this thing ran up from 250 to 260. But I guess conversely, we could also say during the week it ran from 265 to 250. So we might be splitting hairs there a little bit. But I agree with that 250 level. If we back up to that 180-day chart again, you're going to see there's some decently strong support right around here. And this is, dead on 220. I think totally agree this is a good one to wait on, because, it definitely gets more volatile, right? So if we go to our studies and take a look at implied volatility, IV, we'll see, implied volatility has kind of fallen off the face of the earth here. So if we look in the context of the last 180 days, it's been a lot more volatile, meaning those options have carried a lot more premium than they currently do. So I think we can get much better value selling on this at some point in the future as opposed to right now. So maybe a good one for us to throw on our watch list with the 220 price target and just wait and see till it gets back down there. And if it does, I guess we'll be waiting with open arms, as the patience will have paid off. And if it runs away to 500 and we said, oh shoot, we missed out, you know what? Whatever, it is so much better to miss out on a good trade than to be stuck in a bad trade. I guess the other one, MSTR, was what Morpho wanted to talk about. MicroStrategy. And this is one, I think we brought it up in our premium chat room this week. They have a lot more Bitcoin as opposed to something like a Coinbase. So the price action of the stock is a lot more heavily correlated to the actual price action of Bitcoin, which if you're looking for a crypto stock, I think that's something that you should be looking for. However, I'm a little bit hesitant on crypto at these levels, especially since Bitcoin has run up so much so recently and tends to pull back at different points. The fact that selling one of these fully cash secured, if we go to 14 of these, right? If I wanted to sell, look, I mean, these are great numbers ROR on a weekly basis, but if I wanted to sell one of these at a 680 strike, those of you who have played this game with us know that that's going to take $66,000 of collateral fully cash secured, and I just don't know that if that's something that I want to commit to one trade and one option in particular. So I think we're going to hold off on this one as well. You know, another good one that I think potentially to keep an eye on if Bitcoin does pull back to where we can get in closer to the 580, maybe 450 levels, somewhere in there. But for now, I would, tend to try to hold off on something like this until we get some better entries. And, crypto is running pretty hot right now. It typically comes to the forefront of discussions when it runs hot like this. It's a really easy way to get that FOMO, that fear of missing out, and make a stupid play. But, we've got all the time in the world, right, guys? We can just throw this thing on our watch list. We could hang tight, wait for it to fall back to us at this, 450, 580-ish range, and then, reevaluate it when it comes through there. So I think that's the spiel on crypto. There's some decent around to the idea of getting into some of these different stocks. But, I don't think now is the correct entry there. So we had some more requests going down the list. Prinsmeister, shout out to Prinsmeister popping in the Twitch chat again. Always love seeing that name. CHPT and or LCID. We're going to go for both. We are not going to do the slash or. We are going to do the and. All right, CHPT, which I believe is charge point. There it is. And I think they have earnings this week. Correct me if I am wrong. The easiest way to see that is go to our watch list. Type in CHPT again. Did it type in? Did it type in? It did. And they have earnings September 1st after market. So I believe that's going to be Wednesday afternoon. Yeah, it's going to be Wednesday afternoon after market. So we've got some decent, what is the word I'm looking for? Some premium. I feel like that's a word I should have been able to find more easily. But we've got some decent premium on the stocks. Their second earnings, you are dead on, right? We have one earnings event right here back on June the 3rd. And a few months after, we are going to have another earnings event for ChargePoint. But I think this was a former SPAC, right? Correct me if I'm wrong. Former SPAC. There you go. We zoom out. And that is the telltale sign on a chart of something being a former SPAC, right? It was trading around 10 a share, ran up, and is back down to 21. So the general advice that I give on SPACs is anything above that net asset value so closely after the merger for the company, it quite honestly scares the hell out of me because we have seen it go terribly so many times. And is ChargePoint a decent company? Yeah, I think they are. It's actually, probably one of the only ones I've actually seen that's gone public via SPAC where I'm familiar with what they do in real life and have actually seen examples of their product in the world. But 21 is a little bit rich of a valuation for me on this stock, right? Because we remember with SPACs, when they do these reverse mergers to take these companies public, they do so at what the equivalent value of that transaction is $10 a share. So by getting it a charge point at 21, we're essentially saying, hey, I think between now and the date of the transaction, ChargePoint has done something to double in value. And I just don't know if that is something that is accurate. However, decent premium for the upcoming week because of earnings. So let's use that typical earnings process that we like to go through where we plot the expected move. And we did that a little bit last week, and I think something that'll be really interesting to pull up really quickly on our website here. If we go to hourglass-trader.com, I think everyone should be able to view this one now. Go down to our blog. We wrote an earnings primer for last week, and we're going to get back to this charge point discussion in a second, but we like to use the idea of the implied move right here to come up with an expected range. Why do we like to do that? And as you can see in this, we took several different stocks that were reporting at the back end of last week and ran this type of analysis on all of them. We were able to see historical performance before earnings, and then we charted this expected range, right? So for Salesforce, the implied move was 15.18, or more commonly known as $15.18, or a 5.84% move. But that would put that quote-unquote expected range between 244.75 and 275.11. And that is what we plotted out right here. And again, these were all plotted out pre-earnings. I could probably zoom in a little bit on that because that might be looking small on you guys' screens. So if we go to Salesforce and see how that panned out in the context of that expected move, you'll see that that expected move that we plotted was pretty much dead on, right? So it was trading right around here. They beat earnings. It spiked up to the top end of the expected range and settled back down here. So what does that mean for us in the context of our option selling strategies? The answer is that if we sell options outside of this expected range for earnings, we're putting some more numbers on our side to put ourselves in a mathematically beneficial position as we head into these earnings events, so that essentially we put ourselves in positions where we have positive expected value. The analogy we like to use is that we're the house in Vegas. While sometimes there may be some sort of crazy event where after earnings it goes outside the expected move and we lose money, more often than not, we are going to find ourselves making money if we use these concepts like implied moves and expected ranges heading into earnings. And to further show how well this worked, we could take a look at Snowflake. That was another area we plotted the expected move, SNOW. And there you have it, right? It hit the upper end of that range on the expected move, fell right back in. Everything sold outside the expected range, hit max profit. We could take a look at Splunk, SPLK. Stayed within the expected move almost exactly. So it didn't even test the outside of that. Everything sold outside that expected move, hit max profit. We can go down to Dollar General. This is one where it broke the bottom end of the expected move briefly, but pretty much finished up right on the bottom end of that expected range. So another one where options sold outside of that finished up profitably. COTY, Cody, was another one where we plotted the expected move for last Thursday's earnings. And this one did run above it. So I think some of these calls were losers, but if you went on the put side, you'd have made good money. And if you ran a straddle or a strangle, if you ran a strangle at these, you would have pretty much broken even. So in the instances like this where it does run outside there, the premium that we get on the options still gives us that decent bit of cushion. And then continuing the discussion here, right? Peloton is one, another big company that reported earnings last week where we plotted that expected move. It flirted with the bottom end of the range, but ultimately ended, at 104.30, which is just outside of the expected range that we plotted with 105.53. So if you sold just outside there, even right on that number, you still would have made money. And everything outside of that expected range, the low end and the high end, hit max profit for Peloton. But with that in mind, as we loop back to that charge point discussion, and I try to stop myself from getting too far off track here, what is the expected move? And quickly, Thinkorswim calculates it for us up here. It's $1.85. What that really means, though, what the expected move is, it's the break-even price of an at-the-money straddle. So further, what does that mean? Let's pull our handy-dandy system calculator back up onto the screen. And then we know what a covered straddle is from our HT wheel strategy. We know what a covered strangle is from our HT wheel strategy. But a covered straddle, or just a straddle in general, is instead of selling, a put at 18 and a call at 24 to make them both out of the money, a straddle is when you sell the same strike put and same strike call in one position. So if you take a look at an at-the-money straddle, which 21.25, you can't really take a look at an at-the-money straddle, but we'll call it 21 for sake of the example. You would take $1.14, so 1.14, plus the put premium at 21, which is going to be about 90 cents. And that would give you your expected move, which if it were at 21 would be $2.04. However, since it's between those, our expected move is $1.85 for the upcoming week. So that's the actual number. But with that in mind, I probably need to pull that calculator up, but that means we could expect that range post earnings for ChargePoint to be $1.85 higher than the current price and $1.85 lower than the current price. So some quick, probably very rough math here since I'm going to be doing this in my head, but 21.24 plus $1.85 is going to be about 23.10. So we'll plot that 23.10 right there, close enough. Bottom end of that range, 21.24 minus $1.85 is going to be what, about $1.60-ish? We'll call it $19.60. So we'll plot 1960 on the bottom end of the range right there. And we'll extend both of these lines out to the left so that you could view them in the context of the moves of the stock over the past 180 days. So this is the range that we could expect the stock to stay in. And what's really interesting when you do something like this and extend it back over the past 180 days on the chart. You get to see different areas of support and resistance and how they line up with the outside end of the expected range. So from right here, the first thing that should stick out to us, right, is the bottom end of the expected range that we drew right here at 1960. We've seen charge point bounce off of it not once in March 5th, not twice March 26th, not 3 times on April 21st, but 4 times we have seen it happen. Again in May 12th. I've got a comment asking if you've lost me. If you guys can hear me, let me know in the chat. I'm hoping I am still audible and you guys can hear what I'm saying right now. I think everything as of right now looks good on my end, but I was definitely looking away from the stream status for a second, so there's definitely a possibility that I dropped out. Hopefully you guys can hear me. I'm going to put a quick message in the chat saying, let me know if you guys can hear me. Perfect. We've got some confirmation from Morpho that they can hear us. All right, appreciate it. We're going to keep it running. But, just in case I cut out a bit, we see on the bottom end of the expected range that we were plotting right there, we see that it is a pretty strong level of support. So while playing a two-sided approach like a strangle or a two-sided approach like a strangle or an iron condor might not be the best approach to something like this, maybe taking the bottom end of this as a cash secured put and playing it to stay above 19 would be a good trade, because not only do you have that idea of the expected move and the bottom end of the expected range working for you, it coincidentally falls on an area of support. So let's take a look and see what those 19-ish strike puts are going for. And you'll see that they're going for 1.44%, which, as we know on a weekly basis, is a very, very nice amount. And if we pull back up that beautiful system calculator that we had on our screen a second ago, we'll know that 21.24, I'm hitting all the wrong buttons over here, 21.24 is closing price on Friday. So if we sold a 19 strike put for 27 cents of premium, that means our break-even price is going to be 18.26. Yeah, 26. 76. Hold on. I'm losing my mind here. It's a little bit late. 19 strike minus 27 cents of premium is going to be 18.73. All right. Thank you for bearing with me in my disaster of a mental math moment right there. But that's a $2.51 cushion for your break-even price on those 19 strike puts if you choose to sell those, and a $2.51 cushion on a stock that was trading $21.24 headed into the week is an 11.81% cushion. So in plain English, if you sell these 19 strike puts, as long as charge point doesn't drop over 11.8% over the next 5 days after their earnings, you are going to hit max profit, or not max profit, but you're going to make money on the trade. 18.73 is your break-even price, but 19 itself is not too much different than that, and that's your max profit point. So 18.72, this red line down here, would represent your break-even price. And that's a really nice value, right? Because for all the previous earnings examples we looked at, the expected moves, it stayed in those most of the time. And even when it didn't, it still stayed close-ish. So even if it does break below this bottom level of support that we have here, as long as it stays close-ish, these are going to clean up and make you some profit. So objectively, from a purely technical chart analysis perspective, I like the way that this sets up for an earnings play at a 19 strike put. However, knowing what I know and preaching this golden rule of option selling, where we say, hey, we only want to sell puts on things that we are comfortable owning, I'm really not comfortable owning charge point at $19 a share right now, since it's been so soon from, I guess, was that proper English? Am I losing my mind here on stream? Since it has so recently been, that's terrible English too, since we had the merger so recently. There you go. That's a little bit better. Bear with me. But until it levels out a little bit more and demonstrates some sort of staying power at this 20 level, I get flashbacks to what I mentioned earlier in the stream with Hyliion, where it shot up like this, came back down, and what I'm afraid we're looking at for charge point, because if you look at Hyliion, it had this huge number up here. We'll pull up CHPT. Nice spelling again by myself. And I think a good thing to do right here might actually be to use the side-by-side chart feature that Thinkorswim gives us. And if we back this one up to the 3-year, you'll see a lot of similarities in these charts, right? So ChargePoint started as a SPAC, traded around the $10 level. Hyliion started as a SPAC, traded around the $10 level. ChargePoint spiked up to about $50 a share. Hyliion spiked up to about $55 or $60 a share. A little bit more of an exaggerated spike on the Hyliion side, but when it came back down, as ChargePoint is coming back down, there was a bounce around the 20 level on ChargePoint. There was a bounce around the 20 level on Hyliion. And I'm worried what we're looking at right here at this point in time, before it broke below 20 and began a descent down to 10 a share, is what we're looking at right here. And we've got a question from John Michael in the Twitch chat. What is on our list next to check out? So let's pull the chat over here and I'll let you know what's coming next. We are looking at ChargePoint and then Lucid as per recommendation by Prinsmeister. Next up after that is going to be Nvidia, thanks to Worrymen. And then we've got Eskotha from our Discord requesting CPNG. So we'll take a look at that one as well. But after that, and then we have a lot of people telling me they can hear me. So I appreciate the feedback there. But then after that, feel free to let me know, guys. Let me know if you guys have any other stocks you would like me to look at. I'm going to take a sip of water so I stop stumbling over every sentence that I attempt. All right, there we go. But, back to the original point that I was trying to make with this. I worry that this second test of the 20 range that we see on ChargePoint is really, really symmetrical to what we see with that second test of 20 on the back end of Hyliion's drop. And because of the PTSD that I have from that one and this thing falling way, way, way down, I am going to take, I'm going to take this one off. I'm not going to be playing this one this week. If you do like ChargePoint at 20, again, I think another thing that's so important that I like to emphasize is we don't need to have the same thesis on every individual stock. I think we just need to agree about the strategies that we use to play these individual stocks. And if you do choose to go the option selling route, which is what we always recommend, I think those 19s set up pretty well. But I will be staying out because of rule number 1, which is that I don't want to sell puts on stocks at strike prices that I'm not comfortable owning those stocks at. All right, there we go. So the next up is going to be Lucid as we continue our dive into the electric vehicle former SPAC world, courtesy of Prinsmeister. And there you have it again. We're already zoomed out to that 3-year chart so we can see the SPAC action. And, what do you know? We have a former SPAC electric vehicle company that's testing 21 again. However, this test of 21 admittedly is a little bit different because this one has demonstrated that staying power in that lower 20s range that I talked about with CHPT that I was looking to see, right? We still look pretty volatile on the 180-day on CHPT. Lucid is a lot less volatile around that lower 20s range. What's going on with Lucid, though, is I believe they have a share lockup expiry coming up. Let's see if I could find anything about that. Let's see. I'm very confident that this was happening, so I'm going to go to Google really quickly and say CCIV's net asset value on their SPAC was 10, right? So this is to answer that comment, Prinsmeister. They had a net asset value on that SPAC of 10. Really, the only SPAC out there that had a net asset value that was not 10 and up in that low 20s area was PSTH, which is another one that we've been sticking out. But CCIV was a $10 net asset value SPAC that it merged with before becoming ticker LCID. So that is what we're seeing right here. So it still is theoretically at that 2x valuation of the deal price. But another thing to consider about this. So it was trading in the 20. You're correct. It was trading in the 20s before the merger. But that SPAC still started out, as we see on that chart here, at that 10. So the $10, it's still a $10 NAV, but just because that was the price that the stock was trading at before the merger, doesn't mean that that was the net asset value of the stock, right? Because, for example, we could look at our good friend here, Hyliion again, because I know what happened with this stock like the back of my hand, unfortunately. But if we take a look here, Hyliion's merger was here when it was trading in the 40s or 50s. And while the SPAC itself, I forgot, I think it was SHLL, I want to say, is what the SPAC was. So while the SPAC was trading in the 20s, 30s, 40s, or 50s before the merger, that doesn't mean that it was worth 20, 30, or 40. It still has this concept of the net asset value that we see right here at that $10 price level. So back to LCID, and to the point that I was about to make for why I think this might get a little bit dicey in the near future. Here we go. Lucid share lockup. There we go. Mark your calendar for September 1st. So if we close this pop-up ad, yada, 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 yada. Lock up. Come on, show me the word lock. There we go. As per Lucid's original special purpose acquisition company merger, a number of lockup provisions are stipulated, and that can make assessing the lockup periods kind of difficult to understand. So there's this September 1st lockup expiration, right? And if we highlight this paragraph that they pulled from the PIPE registration, we'll see that there's a $2.5 billion fully committed common stock PIPE with the unique investor lockup provision that runs to the later of September 1st, 2021, and the date that the PIPE shares are registered. So this September 1st date is what? It's Wednesday. So as of Wednesday, all of these big investors, $2.5 billion worth of investment in this company, they are able to dump that on Wednesday. So what we're probably going to see into that is a lot of selling as we get into that lockup expiry. So what happens, if you just think about this fundamentally, is there are all these investors who have a ton of money poured into this stock at $10 a share. So on Wednesday, they're going to have the opportunity to dump that investment for $20 a share if that is where the price sticks. So it's kind of a no-brainer, right? If you have a substantial investment and you have the opportunity to quickly dump it for a 100% return, that's probably an avenue that you are going to pursue. So in anticipation of share lockups where the stock has run up a ton before the actual lockup expiry, we typically see some pullback in the stock because people assume that those big time investors will do the smart thing and just take that 100% gain off the table, dump their position in the stock, and move on. So I always caution people when there are upcoming share lockup expiries on a stock, just be careful with your entry. I think maybe Lucid would be one to avoid this week. And if there's the lockup expiry and this thing tanks back down to like the $17 or $16 level, then it could be interesting. But again, that then circles us back to the fact that we have a multi-billion-dollar valuation on this stock for a company that hasn't sold a single car yet. But we'll cross that bridge when we get to it. We'll take a look at this one next week. And asking if it's an IV play, I mean, if you take a look at the IV that we have right here on the chart, the IV reversion plays are typically what you would see on the front end here, right? When there's this big green candle upwards. Implied volatility has just slowly been declining over the past month and a half. So really not a great value right now on options. I'd imagine premiums might be pretty decent in anticipation of the lockup expiry. But yeah, there's a reason that puts $2 or $3 out of the money right now are giving some decent returns, and it's because that big investor lockup is not really a secret. So due to the potential downside risk that event carries, I would stay away from Lucid. With that said, the next stock that we are going to take a look at is going to be, as I scroll through my chat off screen, which is probably terribly exciting for you guys to watch, Nvidia, NVDA, as recommended by Warriorman. And this is a 10-year chart, so this looks kind of insane. But if we go to the 180-day chart, we're going to see a similar story. Oh, okay, so Prince Meister's saying, what if we see a large sale of Lucid on the 1st? And I think that definitely is we'll cross that bridge when we get there. If there's a huge red candle, I think it could be a decent play, at least for a short-term rebound. If we could scoop something up at the $15 or $16 strike level, that's something I might want to keep an eye on. But, as we mentioned, there's only so much we could plan going into this week on a Sunday night. Definitely one of those things we'll keep an eye on as the week progresses and call out in the Discord as we see it. But Nvidia, another one that is just scaring the hell out of me because, one, implied volatility has kind of dropped off a cliff over the past month or two. and 2 on the 180-day chart. This thing has basically doubled in price. So I don't think we have a great entry from that perspective either. To corroborate that claim, we could pull up the RSI and see what that thing's telling us. And there you have it. It's back in there. It's overbought. This is not something that I would want to be getting in on right now. I think a lot of tech stocks, going along with the theme of the whole market, I think are overextended as a whole. So, while it's a decent company, just because something is a decent company doesn't mean that the stock is going to go up forever. This setup really just isn't in line with what we like to target for entry into a lot of our trades. So we're going to leave this one alone for now. That takes us to the next suggestion, which is going to be CPNG. Shout out to S. Kotha as we move into this one. Now, we've talked about it before because there's actually some decent opportunity off this spike downwards from their earnings where we were able to sell some 30 strike puts that were decently out of the money, make a little profit, and keep the train rolling. However, let's revisit those, and it looks like I'm really not impressed with the amount of premium that we're seeing right here, right? So the 180-day RSI says this thing's a little bit oversold. It looks like we might have an area of support right around 30.7, but it's already broken through that, so who knows when this thing might stop. If we take a look back at the 20-day chart, this thing's dropped about $10 a share in the last trading month, but even if you go dead at the money, you're only getting a 5.26% return for something that expires on September 17th, which is a 3-week trade and really not that great of a value proposition for something that is basically at the money and has been dropping this fast, this quickly. So just another one where I think it was a nice entry for us back when we played off these initial red candles because we caught a little bit of a rebound. The IV leveled off. We were able to take some profit on that. However, I just can't convince myself to get in on something that offers a 5.26 or 2.14% return in in 3 weeks time. Now, this might be one where it keeps dropping further and we could revisit this come next Monday or 2 Mondays from now when it's a 1 or a 2 week trade. But as far as being a 3-week trade, these ROR numbers, the amount of risk that we perceive from this sharp of a drop based off where these strikes are in relation to the current price, 1 being dead on the money, and 2, the one being slightly out of the money, only offering a 2.14% return on risk over the next 3 weeks. The risk to reward just isn't there for me, so I would leave that one alone, even though it previously was pretty good to us the last time that we tried to go in on it. All right. So CPNG was the most recent one, and we are about an hour and a half into the stream, so we're going to wrap this up pretty soon. However, I do want to take a look quickly at an old favorite with Zillow again. So the previous lines of support that we drew with this one, if we go to the 180-day, there was some really decent support around the 105 area. And, when we pull up these 180-day charts and we see these big run-ups that look like, the front end of a roller coaster, those are the ones we try to ignore. However, this is similar to the setup that we saw with CRSP, right? There's this big spike earlier in the year, which kind of gives us the blueprint saying, hey, it got up to 220. No reason this thing can't fly back up to 220 again, and it's starting to bottom out in an area that gives us a good entry. Zillow is a really similar, not ZI, but Zillow is a very similar chart from the 180-day perspective when we're trying to evaluate that kind of a setup, right? But the issue with Zillow, when I zoom out on it a little bit to the 1 year, and it's going to have to be beyond that to the 3 year, is that, if it falls below this, what do we see right here? This 88 level, there isn't a ton of support until, 79 or 60. So we've got these $10 gaps between support that scare me a little bit because while it is encouraging when we look at the 180-day chart, if the market does decide to correct itself, this seems like a prime candidate pulled back to the 60 or 70 range. However, there wouldn't be too heartbreaking of a loss. There's decent premium on it on a week-to-week basis. That drop from 100 to 60 or to 70, if it did happen, 1 would be a pretty sizable drop, but 2, it wouldn't happen overnight, and we'd have plenty of time to manage this trade from an HT wheel perspective if we put the principles outlined in our strategy into play on this one. So going back to that 180 day, we saw decent support at 98, 94 is what we had plotted down here, but it bounced nicely off 90. So another one where there's decently well spaced out areas of support. We see the bounce off of 90. We could potentially call that support. We see some bounces off of 97. We could maybe call that another level of support. But with that in mind, the 90 support and the 97 support, let's take a look at the weekly options and see what these things are offering. So we could get 1.25% on a 97. And honestly, I don't know if I'm in love with that either, because this thing is one that has a tendency to have some pretty big intraday drops, right? We see this one red candle back on August 6th that took it from 111 down to 103, which the equivalent of that would be going right back down to this area that it bounced off previously. I think it's chilled out a little bit. The premium used to be a little bit better. Although this is one, I think the best idea for us would maybe be just to keep an eye on it as we head into the upcoming week. And if we see an opportunity where the price of this thing kind of falls off the face of the earth, we'll have the opportunity to get into it and then hopefully scoop up some nice premium at this mid to low 90s level. So that's what we're going to be looking at on this one. So don't like it right now. We used to love it. I like the price it's at, but premium's not incredible for the price action that we've seen over the past month, right? We've seen a range from 114 to 89. That's a $24 range, and we really only get a decent weekly return if we go $3 out of the money. So again, another one where the risk to reward doesn't quite line up, but I think this is a great one due to the tendency that this stock has to have these big red candles at the beginning of a day. So if you see a big red candle, this thing drops back to 97, 96, 95. I think that's a great time to swoop in on a weekly basis and get some puts that have strikes in the mid to low 90s range. So that is an hour and a half pretty much on the dot for the stream. As we mentioned at the top, we really don't have a ton of trades that are in play. We talked about some decent ones, and if this ever loads, you'll see what we're talking about. There we go. We've got a very short list coming into the upcoming week. We've used literally less than 24% of our buying power currently, so we are looking to spend some money. But we have to balance that desire to get into trades with this high-level look that we took at the S&P 500 to say that, look, in the overall market right now, entry really isn't that great. I mean, even back on August 19th, 10 days ago, this thing was back down at 435, the S&P 500. So if we see another drop like that, obviously that would be an incredible opportunity for us to get in on. But RSI slightly elevated. We're going to play things relatively, safe off the bat. Monday, Tuesday, I think is the game plan. We're probably going to dip into more earnings plays than we typically do in order to those ideas that we talked a little bit about earlier with ChargePoint, with that idea of, expected moves heading into earnings. And I think maybe Tuesday night, maybe Wednesday morning or during the day, we might have a special earnings stream. I think that would be interesting to take a look at some of these earnings candidates, plot all the expected moves, and talk about what we see. I think that would be an interesting thing to do during the week because, we could talk about all the earnings plays in the world that we want to right now, but if the price of something crashes between now and their earnings, our analysis could be rendered completely useless, so you won't be able to get anything from it. So that might be something we check back in with during the week. But in general, we're going to be looking to spend. So point being there, and I think we might be lagging out on the connection again a little bit here. Come on, come back to life for me. There we go. I think we're back. But point being here, really short stack of trades. We have a lot of buying power waiting to use, but we think the market, is itching to pull back a little bit, so we're going to be careful with what we enter. We're going to be disciplined with what we enter, and the most important thing we can consider for the upcoming week are the sizing principles that we have with our HT wheel strategy. We're going to start all of our trades small so that if things do pull backwards, we're going to be able to easily manage those. We're probably not going to get some home run like we had last week, but any sort of decent profit is something that we like to aim for. A question from John Michael really quickly in the Twitch chat is, how long do we think SPRT is going to have that juicy IV? And that is a great question because if we take a look at it, not only was there a huge rise, but there was also a huge drop in SPRT. And this is one that actually does a really good job when we plot this. It does a really good job of illustrating that, if I can get my dang mouse on it. Okay, this is embarrassing. Third time's the charm. There we go. A good one at illustrating this implied volatility spike that we always like to talk about. So we know implied volatility historically is right around this 2 level. And even off the initial jump where, backing up a bit, in the last 20 days, the thing ran from 6 to about 13. So it over doubled in price over an 18-day period, and implied volatility still stayed around this 2 to 2.5 range. It wasn't until we saw a move from 14 to 20, which we thought, okay, that's a monster move to get it up to 3. And then that insane move that we saw on Friday to get up near 60 and back down, put it up to about 3.6. So this is the type of implied volatility spike that we talk about, where this thing is inevitably going to come crashing down to earth. The inflated premium on these options, I mean, they're going to come back down eventually. We are seeing some insane pricing, on the puts that expire September 17th. These spreads are a little bit ridiculous, so I don't know if I'd put too much stock into the ROR numbers you see right here. But I would think that if we take a look at the 7.5s that we were playing are about 40. I mean, we got in for 45, got out for 35 on Friday. It looks like you can get back in for 40, so maybe not the worst idea in the world if IV levels back out, but I mean, you have an expected move of $13 on this thing between now and the option expiry on September 17th. So that would put you at 13. I definitely wouldn't want to sell these at 13 because we at least want to sell in an area where there's some sort of decent level of support. And as we plotted out with this line, that's right between this 5, 6, 7 area. So that's why we went with the 7.5 strike puts when we traded it. But if you want to get back in for these 7.5 strike puts and get a 40-cent fill, I don't think that's going to be a bad trade at all. The only thing that's kind of a pain in the ass with this thing right now is the buying power requirement is dead equal to the max loss, so they have to be fully cash secured. So it's going to tie up a bit of your cash, but you'd have to think a 5.63% return over 3 weeks for something that is super high percentage is not the worst value proposition in the world. So if you're looking for a place to park your money for a few weeks, that could be kind of a fun one to keep an eye on and watch these concepts of IV reversion come to life and hopefully make you some money. But with that said, I mean, maybe we dip back into those this week as well if that opportunity presents itself. One of those is kind of tough because there isn't a lot of action right now from an IV perspective in the overall market, so there aren't a bunch of great entry points, and that's why we just don't have a lot of plays headed into the next week. And one of those things where you don't have to load up your portfolio every single week. Holding cash is a position too, right? Because if you're 100% cash and the market drops, guess what? You've outperformed the market. So, I mean, we always want to have a little something going so that if the market keeps ripping upwards, we're going to make some cash. But we're treading very lightly headed into the week. Not a ton we could plan out as we head into this, other than a few of those that we talked about that came up on our scanner. But, big thing this week, and I feel like we say this at the end of every week, but being on that Discord, being ready for those alerts, I think is going to be very big as we head into the upcoming week, because if there's a big crash in the market or if we see some more of these implied volatility reversion opportunities, those are some really good places to park your money. Because another great part about the IV reversion strategy is the fact that, this thing's moving all over the place without regard to the S&P 500, right? So if we sold 7.5 strike puts on this and the market crashes, we're probably going to be fine because this thing could drop 50% tomorrow and it still wouldn't be at our break-even price. So that is one big reason why I've tried to shift to a lot more of these IV reversion type trades, because they behave relatively independent of the market. And if we do get this big pullback in the market that we're kind of expecting at some point here, we're not going to get crushed by it. And that could really help us go a long way in outperforming the S&P 500 for the remainder of the year. But with that said, there's going to be a lot of action in our trading account because we're going to try to fill this up a little bit. We're going to be strategic about when we do it. We're going to have our eye on entries. I'm monitoring the market all week in our Discord server as we look for some good entries as we get to our shameless self-promotion portion at the back end of the stream here, where if you want to get all of our alerts, and we give out one free alert every week in our Discord server for trades that we're entering. This past week it was with FFIE, and I think that trade, it hit max profit. There you go. Would have paid out $250 if you entered into that one. So there's still some decent trades being thrown around on that free channel. But if you do want to join our premium server, we've got a really active premium chat right here. We've got all of our trades that we put out alerts for, and they've been performing pretty well. If you look at our last week, all of the newly alerted trades that we had, they went 13 for 13 pretty much and made us about $3,700 in profit. So that was one that we were super happy with last week, and all of those alerts were found right there. Additionally, you're going to get trade plans that have write-ups for some of the more involved trades that we get into. We've got a live watch list that we use and links to the option scanners that we pull up in here. In addition to that, you'll also get some other blog posts like this earnings primer that we released out this week. This was only available to premium members. But again, it's less than $1 a day, so we've tried to keep it affordable. If you cannot afford that, there is also an option to get a free month of HT Premium. We also have a free 1-week trial. But we figure at less than $1 a day, when a lot of these trades are making, overtrade, it's a decent investment in your trading career to, sign up for that program. So that's something that we have been working on lately. And we've got some complainers about our lag. Whoops. But that is the end of our shameless self-promotion here at the end of our stream. But that HT Trades channel is where we're going to be alerting every single trade. We're going to have one free trade in the Discord this week. But as always, the goal, if you want to learn our strategies and discuss our strategies, you're going to be able to do so in our main chat room. We've got the beginner questions channel. These are always going to be answered. Always going to be free to learn. Our YouTube channel, the videos, the instructional videos, the strategy videos are always going to be free. So it's really just an addition to what we already offer, as opposed to just putting everything behind a paywall. But with that said, we have gotten to the 1 hour and 40-minute mark, and I think my connection is barely hanging on for dear life here, unfortunately. But for those of you who tuned in again this week and bared with me through all of these, all of the lagging that we've had on our stream so far, thank you so much. Hopefully the replay is a little bit clearer on YouTube and Twitch when that gets uploaded after this. But we are going to sign this one off the way we always do.